First of all, welcome everybody. Thank you for joining this Allraise event hosted by the Boston chapter of Allraise. Today we are excited to have a wonderful group joining us to talk about fundraising and specifically in uncertain times. I'm Lily Lyman. I'm a partner at Underscore VC. We are an early stage firm here in Boston. We focus on seed and Series A B2B software with a Boston bias, and we specifically focus on a community-driven model to venture capital. I've had the pleasure to be part of the Allraise leadership team here in Boston, joined by several others on this call, Gabby and Kate, many others. And the mission of Allraise, for those who don't know, is to promote female funders and founders. Many of you know that there is a large gap in the amount of female funders out in the world, and particularly around the percentage of capital going to female founders in the tech world. So the organization is focused on fixing that and improving those numbers, and we're very excited to be part of that change. So the topic today is one that I'm very excited about because in my several years in venture, one of the reflections that I've had that I love is that oftentimes what entrepreneurs experience in terms of fundraising from VCs, I also hear the feedback, oh, VC is such a black box. We want more transparency and it's hard to understand. I think one of the beautiful things of the venture capital industry is actually VCs, as they are raising their own funds and fundraising from LPs, they have to think about a lot of the similar things that entrepreneurs have to think about, which is what is my strategy? Where am I going? Who should I target as a potential investor? How do I navigate it? How do I tell my story to stand out in a busy market? So it's a lot of the similar themes. So one of the things that we wanted to do today is shed some light in what can be a black box of raising a venture fund. And so joining me for that discussion today is a wonderful group. We have representatives both from the GP side, so folks who have raised a fund. So I'm joined by Suzanne and Rudina will be joining shortly, and I'll let them introduce themselves. And then we will also be mirroring that with the perspective of LPs who make those investments. So we are joined by Alison from Boston Children's Hospital and Maureen Austin from Cambridge Associates. So it's a wonderful group. And the other context to layer on here is that this is, fundraising can be a challenging and opaque activity anyway, let alone throw in a global pandemic that prevents us from getting on planes and building relationships face-to-face in a business that is very relationship-driven and very much about the people. So that is the framing for a little bit of our conversation today, and we are grateful for you all for joining us. I will say I will have the panelists introduce themselves, and then we have some questions that we will ask to kick things off. But if you do have questions that pop up throughout the discussion, please feel free to throw them in chat, and we will try to address some as we go. And if not, we will have a big chunk of time at the end to answer questions because we want to make sure that this is helpful to all of you. So with that, I will start with some introductions. So for my lovely panelists, if you guys don't mind saying your name, your role, your firm, and sort of what your firm focuses on, and I will just popcorn style call on each of you. So I will start with top left of my screen. Maureen, why don't you kick us off?
Thanks, Lily. It's wonderful to be here. Maureen Austin. I work at Cambridge Associates. I'm a managing director in the private client practice. In that role, I advise high net worth families on their asset allocations, and I have a particular interest in the venture space, which we'll talk a lot about tonight.
Wonderful. Thank you. How about Suzanne?
Sure. Thanks, Lily. Suzanne Norris. I'm one of the managing partners at Victress Capital. Victress Capital is an early stage venture firm. We focus on the consumer sector and we look to back teams that are gender diverse. So either have a female founder or have a woman on that kind of core management team. We started the firm 5 years ago, and we currently have 23 companies in our portfolio.
Great.
And we're based in Boston. Sorry, I should say that.
Great. Alison, you want to go next?
Sure. I started my career in consulting. Actually, I'm a Cambridge Associates alum as well, but feels like a long time ago now. And spent the first part of my career in just private equity, working for consulting firms. I went to Brandeis University, where I was the director of investments and subsequently the acting CIO for 2 years. And then after that, I went to Boston Children's, and I've been with Children's now for 10 years as a director of investments.
Wonderful. And Rudina, have you joined us? Rudina had a board meeting that was running a little bit late. Okay, we'll have her pop in as she's able to. And reality adventure, and also just to name it, lots of people have children at home, so if you hear some screaming, it's just sign of the time. So we're very comfortable with it. Great. Well, I'd love to start with a little bit of a 30,000-foot view, thinking about the market and venture as an asset class. And so, Maureen, I'd love to start with you on this one. It seems if you look at a lot of the data, early stage venture is busy and as competitive as ever. At least that's sort of what it feels like on the ground. But I'm curious from your perspective, and actually I just looking up this data, it's interesting. So in 2020 just surpassed 2019 in terms of total dollars raised by venture funds. So I think it's something like 57 billion across almost 230 funds raised just this year. So it's interesting. So I was curious, what trends are you seeing in terms of flow of capital to venture as an asset class? And, what's changed over this past year, if anything?
So, so great question. To put it in perspective, well, let me just take full credit for all of the interest in venture, because earlier this year, I did write a paper that venture capital positively disrupts intergenerational investing. And I think it just opened the gates for everyone to decide they should invest in venture. But that paper was really targeted to families to recommend that they consider allocating 20% of their portfolios to venture, really primarily based on the fundamental technology transformation that's underway that we're all seeing and living candidly every day during this pandemic. We're seeing the benefits of the technology transformation. So yes, I think people are starting to recognize that more capital to venture can make a lot of sense. So some of the trends we're seeing is LPs, clients looking to get access to more capital, trying to figure out where they should allocate appropriately along the various stages, whether it be seed, early, growth, and late stage. A lot of money going into the late stage and the growth side of the equation, and very high valuations. On the seed stage, and while we're seeing valuations, you're all seeing valuations go up. I saw a chart recently where the valuations in the seed stage have not gone up as much as in later stages. And there are obviously reasons for that. And there are more experts on the panel than I am that can address some of those things. So, we're seeing a lot of interest in the space. In terms of competition, I guess I would look at competition in a couple different ways. Competition for capital, there seems to be plenty of capital to go to GPs. Maybe some GPs are able to capture more of that capital than others, but as an LP, we see the competition of trying to gain access to various funds. So we see competition in that space. And I'm guessing that the venture capitalists are seeing competition in terms of ideas and talent. Although the VCs I meet with all have proprietary deal flow, so I'm guessing there's no competition for deals in the VC world.
Of course not. Never. Thank you for that context, and it's interesting. I don't always think about the LP perspective competition to get into the deals, but it's certainly a very real dynamic. Alison, from your perspective, as you look ahead for 2021, I'm curious, are there any shifts in the fundraising environment in venture that you expect to see, or what are sort of your predictions for the next year? And specifically, is there a nuance between emerging managers versus established managers in terms of what you think the outlook will be for next year?
Yeah, I don't want to make predictions, but
I guess I should have prefaced that with the only thing that's certain right now is uncertainty.
But I would suspect that the established firms continue to kind of not have any issue fundraising. We backed some of our existing managers that are sort of long-time venture investors and long-time investments for us. We continued with their fundraising through March and April and June and kind of some of the tougher months. So I think that will continue. And a lot of those firms have an established LP base. So I think LPs will continue to back their managers, and I don't see much happening there. And then on the emerging side, this is just my perspective, because I think today, especially, any LP you talk to is going to have a different answer in how they're diligencing, how comfortable they are investing in someone that they can't physically fly to, and think everyone's going to have a different opinion, and there's going to be different degrees. Okay, what, you know, if I went to San Francisco once and met with someone, is that enough, right? Or some people are perfectly comfortable doing it all over Zoom. So I think it's a mixed bag, but you know, at the end of the day, at least for me personally, I think emerging managers, it's going to depend on all the things that it's always depended on. So what's their track record? Are they coming out of an established firm? Do they have their own track record? Is the strategy interesting? Do they have a differentiated deal flow force? Kind of everything that's always been there, I think isn't really going to change. It's just a matter of how we go about finding that information.
Very interesting. And as I said, there's parallels on the venture side of how do you get comfortable making these investments and writing these large checks when you can't meet someone face to face. Before we move on, I do want to welcome Rudina, who has joined us. She's come from her board meeting. Rudina, do you want to just do a very quick intro on who you are, your role, and your firm?
Happy to. My apologies, everyone. The can't control board meeting, no matter how much buffer one builds, but that's on me. So Rudina Seseri, I'm founder and managing partner of Glasswing Ventures. We're an early stage focused fund. We have invested in enterprise, so B2B, cybersecurity platforms, software companies where they're leveraging AI and frontier tech at the core of the product. We do have an East Coast focus. And what was the last part that I was supposed to cover, Lily?
That was it.
All right, that's it.
That's perfect. But now
investing out of $112 million fund currently.
Perfect. Thank you. So I want to pick up on the thread that Alison just spoke to in terms of emerging managers and what do you need to show and what is that fundraising process like, in particular as you're sort of early. So Suzanne, I'd love to turn to you. One of the things that we always tell founders as they're fundraising and thinking about timing, they say that you can raise with all the promise or you can raise with all the proof. And both of them can be successful in that approach. It's just a different approach. So I know that you guys just closed your second fund, correct? Congratulations.
Yes. Thanks.
Very exciting. So I'd love to understand a little bit about, what did you focus on in your story? And what do you, because in Fund 2, oftentimes mixed results in Fund 1, you're still kind of early. So what do you think it was for you that you wanted to focus on in your story? And where do you think got your LP's conviction to write that check for Fund 2?
Yeah, so hold on, I guess I'll turn this phone off. Sorry, it's two phones in the office. Anyway, on our story, so Lori Cashman is the other managing partner with me, and we've been together for 5 years. And when we started, my background is on the operating side. Lori's background was on the investing side. She was in private equity firms. And so when we came together, I mean, while VC firms often have a mix of operators and, PE back or VC back experience, she and I felt that it was important to build our track record together, both as investors, but also as partners. Because I do think, as everyone on this call probably knows, it's not a 1 or 2 year deal. You're really signing up for 10 years for each fund that you're together. And so we were able to form the first fund largely with friends and family checks and personal capital. It was a much smaller fund. So we took, we thought that by doing that, it would allow us to build a story and show that we could find great investments, fund them, support them, and eventually get them, where they need to be, whether that was another round of funding or an exit. And not only would we have the track record together, but again, we'd show that as a partnership, we could do this. And so that was what we focused our story on. So the first fund was quite small, to be honest. I mean, it's definitely in the micro fund size, but we did back 14 companies. They've all done really well. So when we went to market to raise Fund 2, we had that story and we focused very much on that. And I would say a lot of the questions were about that. How did you find your deals? But also for the two of us, and I think 2 women raising a fund, we got a lot of questions, how do you work together? How do you manage life? Things that I don't think guys would have gotten asked, but we certainly got to ask them. And so being able to look back and say, look, we made this commitment. This is what we've done. We've hit every milestone we needed, et cetera. I mean, that was a huge part of the story. And I think what allowed us to raise Fund 2.
Very interesting. I should say to the panelists, feel free to jump in if you guys have questions or comments following up on folks' comments. I guess, Rudina, I would ask from your experience in raising Fund Run, you came from another firm and had a bit of a track record. in your perspective, what was most important for you in your fundraise? What do you think helped you stand out, and how do you go about showing that as well?
Yeah, happy to. I don't think it's a single factor. I think it's sort of the packet that comes together. So as you shared, we had an attributable track record, a legally attributable track record, which helped. And in my view, it was a strong track record. So it helped a lot because unlike when you are an operator jumping from being an operator to a founder, where it's the company that and what you have built, which is as credible as anything, you at least show the track record of your investments, and it was a track record on the same types of investment and the same strategy. So I think that was an important factor. The team point came up, much like Suzanne noted, to build and elaborate on that, came up a lot in Fund 1. There was a discussion on that point that was fairly short because I and my co-founder had been working together at the time for 10 years as a team. Now, it's 15, 5 years later, 4 years later, wherever we are. So that was very helpful. So the team dynamics, and then differentiation, whether, there is proprietary deal flow, how one adds value. So I would say, show me the dollars, talk about the team dynamics, because partnerships are much more like democracy, although not everyone perhaps is created equal, but it's much more of a group decision making, especially when it's unanimous rather than a CEO at the helm in the typical structure. And then the story behind it, sort of all in a packet. The more data points, I would say if I had to single one facet, it's the founders that we had backed. The degrees that they stepped up, not just to be references. I mean, I have examples of founders who had exited 3-4 years prior to Rick, my co-founder, and I spinning out, who flew on their own dime to meet LPs that were doing site visits. I mean, that speaks in and of their own a lot to sort of what you've done for those founders along the way and the relationships that one builds. So I will be eternally grateful to those founders and in the present and beyond.
Yeah. Thank you both. I think you just highlighted a couple of really important things. I want to reiterate them to play back just because I do think it's so important. So we talked about the importance of team, track record, strategy consistency, proprietary sourcing, which I want to follow up on because I think it's an interesting topic, decision making as a team, founders, some really important parts of the story. I guess I'd turn it over to Alison and Maureen. Maybe Alison, I'll start with you. Anything else that hasn't been covered that you look for in an emerging manager who maybe is out raising Fund 2, Fund 3, trying to show that early proof points? Anything we missed?
I don't think so. I'm trying to think. I think also just I would emphasize that I think how we figure that information out lots of times as well is through heavy referencing. So as Lily may know, we do a lot of reference calls on our team and really try to kind of get to the root of all that information via referencing, not just speaking with managers.
Got it. Maureen, anything on your end that you also look for this stage, the emerging manager fundraise?
Yeah, well, you captured the key points. Everybody captured the key points. So a little bit on portfolio construction too, right? So as you're evolving and you're looking at how you're putting the portfolio together and the reserves. I also like to hear about the challenges you face. What hasn't gone well? I think too often it's, touting all the good, but we all know that there's some things that just don't go right. And I like to hear how the team is dealing with setbacks and things that just didn't work out the way they wanted them to.
I love that one because I also think it plays into a little bit about what Suzanne was talking about. Was how does a team work together? How do you make decisions both in the highs and the lows? And the other thing that I've heard from LPs is references with founders that the company didn't do that well, and how did the investors handle it in the lows as well? Can speak to the team.
Another thing that I should have mentioned, sorry to jump in, is co-investors. Who are you working alongside? Who else is coming into the deals with you? Who are you going into deals with as well? That's another interesting component.
I was also going to say, I think we're getting to this later, but fund size, I think it's a really big part of the conversation. We're we're talking about that a little bit later, so I don't want to dig in too much, but that's certainly a meaningful piece of, what we're looking at.
Well, let's jump to it while we're on here, and there's actually a question about it in the chat. So can you say a little bit more about why does fund size matter? How do you take it into account as you're evaluating an opportunity?
Yeah, so I think linking your fund size with your strategy is incredibly important. Raising too much can lead to sort of prolonged, fundraising periods, which I think can send a mixed message to the market. But then more importantly, raising too much can also impact long-term returns and discipline and putting money to work in best ideas. We feel very strongly that a portfolio should only consist of the best ideas. And sometimes I think when people get beyond what they're capable in terms of putting money to work, they start to go to the next tier of investments to kind of get that money to work. But then on the other side of that, I think this particularly affects because I'm a generalist, so I look at beyond VC, but I think this really affects VCs is, being able to make the ownership that you want to get in a company, and then also maintain that ownership through various rounds. It's not an easy job. I've watched through, fund sizes, so many managers, and it's a bit more art than science, but it's an incredibly important piece, I think, because it really is the start of how you're going to invest the portfolio.
Interesting.
And it's interesting from the manager's perspective, from a GP perspective, because understanding also the profile of the LP, some LPs feel strongly about a certain minimum size, either because they have, very large assets that they need to allocate. They have a minimum of 50 million and they don't want to be more than 10%. Well, if that's the case, you can build a relationship. If you ever think you're going to go down the path of multiple funds and some that are mega funds, but otherwise, qualifying. So it's a two-way street. Understanding the prospective LP's profile is also very, very important.
I think that's huge. And similar to, again, how we advise entrepreneurs to sort of filter their target investors, I think similarly, GPs need to think about that as well. Suzanne, how did you think about this with your latest fundraise in terms of target fund size and also how that affects which LPs you went after?
Yeah, so we had a target of 20 million. So we're micro fund, or consider micro funds, we're sub 50. We ended up closing on 22. So it was great. We exceeded, but it's exactly what Alison said. We had our strategy. Lori and I wanted to remain the two GPs in the fund. We wanted to look at seed round checks, and we wanted to build a portfolio of 15 to 20 companies. We wanted half of the fund to be saved for reserve funding for the handful of, that initial round of checks for the handful of companies that, were outperforming, and we had even more conviction in by the time they came up for their A or B round. So when you look at it that way, and we were very firm on that strategy, 20 to 25 million, that was sort of the range that allowed us to do that. I think what's interesting was, I'd say, when we started out and our target LP, was and remains for this fund, high net worth individuals, family offices, we're too small. A $25 million fund is too small for any institution. So it took a lot of meetings. Actually, Maureen, we were in Cambridge a couple of times, just getting to know LPs who may fund a larger one if we went in that direction. But I don't know if that's the direction we'll go in. We like the strategy. It's working. The size fund allows us to have a small and lean and mighty team, but it allows us to really hone in on what we do well. And I think kind of having that compass and sticking to it is interesting, because I'd say half the meetings we went into, everybody said, well, why aren't you raising 100 million? Or why aren't you raising 200 million or 300 million? And it's, it's the factor of fund size is just so crazy now that we looked like we weren't ambitious enough, or we didn't believe in ourselves enough. And I would say we had 100% conviction in ourselves. That's why we stuck at this fund size. So I do think having a fund size that you believe you can absolutely knock it out of the park with is what you want to do. And for some, that might be 20, because we love the early stage and we wanted to be two partners in this fund. For some, that might be $1 billion, because you want to go for the later stage. But I think really knowing what your investment strategy is first, and then figuring out the size of your fund second, is really the way everybody should be thinking about it.
I think that's hugely important. I think there's a bunch of questions in the chat, so maybe I'll give a quick opportunity. We can talk about some of those. Rana, do you want to ask your question? Jenny can unmute your mic.
Sure. Hi, everybody. I'm in like a dark room. Yeah, so I was, as a founder, you're always told to find VCs that share your, core values and be selective. So I'm curious, when you're raising, when you're talking to LPs, what are the criteria for selecting LPs? And also, this is a great conversation, so thank you.
I'm happy to start tackling it. So I will start by saying you would love to be strategic and sort of get different LP profiles in the fund. So as I think about our fund, we have endowments, we have foundations, we have a couple of fund of funds, we have one pretty sophisticated public pension funds, we have some single family offices, and then we have some very, very small investors that are family and friends. In fact, I was at some point having a discussion with our controller, and I said, but we only have like a handful of LPs. She's like, no, you have longer than that, but the bulk is your institutional investors. So in an ideal world, you get investors that are, one, very familiar with venture and the asset class. You don't want to be the experimental allocation that is not there if you do your job. At the end of the day, it's dollars in and dollars out and returns out, but you want LPs that are committed to the asset class, so that there is a consistent relationship over multiple funds, and ideally some diversification, in my view, in those buckets. And then there's a whole other group, which is I think of them as the big consultants and platforms. Maureen is with Cambridge, so you have Cambridges of the world, you have Mercers, you have Franklin Park, sort of the smaller groups, but so you have those buckets, and they open the doors to their underlying LP or their underlying clients. And then, you have, as a third category, sort of the Goldman Sachs and Morgan Stanley's, the wealth and their own groups. So the profiles of our LPs, believe it or not, are a lot wider, even within the institutional buckets, than perhaps venture in many ways. At the end of the day, you can make all the mapping. It's supply and demand, and who you have access to and who you don't, and what relationships you have built over time. But in our approach in building Glasswing, that's sort of the path we took, and those are the buckets. I don't know if it's helpful.
I'd be curious to ask this on sort of the inverse side to Maureen and Alison. How do you like to meet managers? How do you typically get introduced, or how do you find them? And then how do you like to build a relationship over time? So maybe Maureen, maybe we'll start with you on that one.
Sure, happy to. So I'm always interested I have a passion for the venture space, and particularly for new and emerging managers. Lily and I have talked a bit about some of the research I'm working on now about how do you identify new emerging developing managers that will be the key ones to partner with. So I like hearing about what's out there. I'm open to someone emailing me and having a phone call. It's great for us to get it on the radar screen. To Suzanne's point, even a fund that's starting out as small may end up being a larger fund. We tend to have LPs that have a lot of money to put to work, but we also have families that don't put as much to work in the venture space, and smaller funds can be quite appealing to them. So an email, if you want to email me, I'm happy to have a conversation, usually a phone call, and then you keep me posted on what's going on. I don't always reply right away, but I do eventually get back to you. And that hasn't changed pre or post COVID, I would say. It's nice. I will say that a warm email will get you probably a little bit higher on the inbox. If you know somebody I already know, I mean, it's sort of the classic sales, right? Who do you know? But I don't know if that's helpful, Lily, but generally I like to hear the story. And in anything, I do some coaching of kids who are looking for jobs, and it's the classic sales pitch, right? When you get, I tell them about high value contacts. You need to have your pitch down pretty clear, concise, and compelling when you get somebody's attention. I'm forgiving. I don't necessarily hold you to, a super high standard, but it's just a piece of advice. Don't just wing it. Don't just be overly casual. You don't have to be overly formal, but know what you want to say, know what the message is you want to get through. And just keep the person in your follow-up.
That's very sage advice. And you are so warm and welcoming that, I think too often people might treat things too casually. You're always be selling, for better or worse. I think there's some truth to that. Alison, what about you? Anything different in terms of how you like to get introduced? Or I guess the other maybe nuance of this question is, what's changed for you with COVID in terms of how you meet new potential managers?
Yeah, so I don't think it's that different than Maureen. I would say I do like when things come from our existing managers. For the same reason, I think Maureen mentioned one of the things that she looks at when she's diligencing is co-investors, right? So other people that you find yourself on the same cap table as often, you've worked with them, you know them. So if Lily sends me an email and says, hey, this person's fundraising, we've worked with them, we sit on boards with them, that's almost like an initial reference call. And so that's going to warrant, definitely a first meeting at the very least. And it kind of helps with our funnel because, we're a team of 9 people and it's a lot of deal flow to go through for just 9 people. And I've also been on the consulting side. So that funnel is just as busy and it's kind of a way to narrow the funnel a little bit. I obviously take lots of cold calls and try to get back to everyone, but when it comes from someone that we know and that we work with and we respect, it helps kind of get that initial, conversation going.
And that sort of, someone asked sort of the role of co-investors potentially. I think that speaks to part of that question. While we're sort of on the theme of what's different this year, Suzanne, you've raised a fund pre-COVID and now in COVID. Was anything different about your process? Any lessons learned?
No. So the first one, like I said, was mostly, friends and family. There quite honestly was not a fundraise for Fund 1. Fund 2, there definitely was. And we were, 70% raised by March and had June 30th as our deadline and didn't want to extend it. So COVID hit and we frankly were like, oh no, like this can't happen. We are not closing this fund with a third open. So ironically, I think it made us bolder. I think we really went back into our network. We went into LPs that already had committed and had gotten to know us over the year that we had, done our first close and saw the companies we were building in and really reached out and asked for, further introductions, et cetera. We did a lot of Zoom calls, obviously, but we were just bolder. I mean, the clock was ticking. We were not going to miss that target and we just went for it. And I don't know if COVID happened, if we would do that. Cause I think there, in COVID, pre-COVID, you would have wanted an in-person meeting and that can take weeks to get on someone's calendar. Whereas COVID hit, everyone was home. You knew they didn't have an excuse not to take your call. So we were just relentless. So maybe that was a silver lining. It made us bolder and relentless to make those connections happen.
Well, congrats on getting it done. That's part of the grit that
I might have aged 100 years, but
no small feat. On this theme, and I do want to name it, and then I'll get to, I know there's a lot of good questions in the chat, so I'm not ignoring them. We'll have time for that. But, this is an all-raise call. And, with the mission of helping female funders and founders, a question that I have for the LPs is, do you see any distinction on how female managers go out and fundraise that's different than their male counterparts, or do you evaluate them differently, perhaps part of a D&I criteria or anything like that? Either one of you can go first.
Well, Alison, I'll jump in, and then so I guess other than the fact that men think nothing of wearing t-shirts and baseball caps when they're fundraising, I've not seen a woman do that yet. One day, I actually had a call with a venture manager. I wore a baseball cap because I was making a statement. So, Lily, you make a good point. One of the reasons we're here is that the fundamental fact is that there are not enough female-led funds in this space. And in a way, it's hard to actually quantify the differences between female and men because the sample set for the female is much smaller, and so I wouldn't necessarily want to make generalizations. But I will say the bottom line for me is I'm looking for competency and sincerity, regardless of what you look like or what you wear, and so, and again, I don't like to make generalizations. I will say that the women I have met, so I'm not generalizing of female funds, but the female fund managers that I have met are incredibly competent. There's just no BS factor. And I just encourage women to be unabashed about your success and your capabilities. I mean, to Suzanne, you know, go bold, right? Like just be relentless, and don't hold back. But again, I don't mean to, you know, not answer the question, but I think the sample size is a little bit too small to actually put generalizations out there, but.
And that's why we're here. Alison, anything to add on that?
No, I would agree. I mean, I would hope that I don't see any difference who I'm sitting down with, to be honest. And I just, you know, most of the time I just wish I saw more, you know, minorities in general, right? And but it honestly doesn't make any difference. And I think a lot of the people that it's kind of a privilege to be in this industry. I think we meet a lot of very impressive people from various backgrounds. So I don't really see that much of a difference.
Rudina, I'd love to ask you, you know, you have a primarily female partnership, but not necessarily a female-oriented investment focus. Do you think the partnership makeup has impacted your fundraising or who you go after at all? Or how has that played into your strategy, if at all?
Yeah, so it is a woman majority firm. You know, there are 3 partners that are women: myself, Sarah Faye, who's with you at All Raise, and Carol Myers, who's our venture partner and a wonderful and amazing operator through and through, and now VC. And then, of course, we have our fair share of, you know, male partner, Rick Grinnell and team. So it's a balanced team, but it does have more of a women majority. I will tell you that I get the question of, did you get any minority and diversity and women allocation dollars? And I will be honest, zero of the dollars committed to Glasswing from our LPs came out of a diversity bucket. But, and that's a big but, where I do think we saw a difference, or I experienced a difference, I lead our fundraising for the firm, was that there were a lot of women LPs, sort of like Alison and Maureen, who would say, oh my gosh, I wish I saw more women and you guys are qualified. So it was in the subtlety of, I can't quantify what extra mile they went to get it through their investment committee or whatever their respective processes were, but there was conviction and it played a role. I actually, perhaps it's selfish, but I kind of am glad that we don't have minority dollars. Nothing wrong with that. The capital is capital and you deploy it and you generate the best returns. But I kind of feel like we're as good as any other gentleman out there. So I want to compete for the real hard dollars and don't shove me in a category. If it helps get more women in the market and there are minority dollars, bring them on. But from a competency point of view, I don't think that we are any inferior. To the second part of your question around how has that impacted our investing, no, we do not have a women mandate or minority mandate. You know, we're again going for the best performance. Having said that, we do think that diverse teams make for best outcomes. So we track within our portfolio, we don't just track our firm, we actually track our advisors and what our composition of our advisors is, and then the portfolio companies, executive leadership and rank and file. We track on gender and we track on executive leadership. And I think 40% of our executive teams are either women or minorities, which is almost triple what you see in the industry. Yeah. And I think we're just about, I think 2.5 times, I hope, I don't know, Emma Marty will give me the exact numbers, she tracks this from our team, but on rank and file where the industry is. So it makes a difference to have diversity at the table. And I think 80% of our boards have at least one woman or minority director. Have I ever stated that? You have to have, no, but showing up is half the battle.
Yeah. I think even just having the tracking in place is also leagues ahead of lots of people. And I think, you measure what matters. It's an important piece to it.
Founders Care. I was talking to Ed Walsh. She's the CEO of Chaos Search here in Boston today. We're recruiting the head of marketing there. If anybody is interested, with some database background, and he said to me, please, 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 I don't want to see any men. I need more diversity on my team. Do you know how new of a notion that is? And I'm hearing it everywhere. It's wonderful. I think the market has caught wind of diversity as a core business decision.
I agree. I think we've seen a big change, not only in the past year, but particularly in the last sort of 5 months or so. So in that vein, speaking about diversity a little bit more broadly than just women, we've seen some LPs make bold statements like Yale coming out around, their policy on diversity in their own portfolio. And there's a conversation in the venture community around D&I initiatives that have to do with diversity in LPs. So anyway, everyone's thinking about it in terms of how do they get in their strategy. But I was struck at the All Raise conference a couple of weeks ago. There was a conversation with LPs, and one of the LPs said, "Look, yes, it's very important, but I'm not going to pull out of one of my top performing firms because I don't really have the leverage. In the same way, it's a competitive market. I'm not going to pull out a benchmark. I'm going to, even if they don't push for diversity." So I guess the question is to Maureen and Alison, in your respective firms from Boston Children's and Cambridge, to the extent that you're comfortable sharing, how are you thinking about a D&I agenda, and is it affecting which managers you work with or what you're asking of your current managers? It's a big question, I know.
Alison, you want to go first?
Sure. So, I think Boston Children's has, a really strong sort of stance on this as an organization, and they're very vocal about it. And I've always felt it working here, which I don't think I've always felt it everywhere else. So I have I certainly appreciate that. And then on the investing side, we have not organized anything like to Yale's extent, but I actually think it's great that Yale is, because they kind of have a pretty loud voice and people listen. And so I think that's a positive direction for the industry to have someone with that voice making such a strong stance. And just as a person and investing, I certainly look for diversity in thought, and I think everyone on our team does, even if we don't have a clear policy on it.
Great. Thank you.
From a slightly different perspective, so Cambridge as a firm, I'm very proud that Cambridge is really committed to diversity and inclusion. And oh, by the way, also ESG, sustainable investing, internally and externally. So internally, we have a corporate social responsibility statement. We have programs that are underway. And then externally, as I think this came up earlier too, as we're doing diligence on a manager, it is a component of our diligence now. And it is something that we are rating managers on, both their own funds, but also the types of founders that they're willing to invest with. Look, capital, that's where the difference is going to be made, right? When the capital gets allocated to competent sources. And so, we have to start making some changes and actually create what I've heard a term that I really like is this allyship. I'm sure everybody's heard of this term, but it's and also just understanding maybe more the implicit bias that some of my LPs might have as they're looking at a fund, and how they're hearing, say, a partner who's left this firm to start their own fund, partnering up with an entrepreneur that has left some high-flying company, happen to be 2 women, maybe versus 2 men. And, there's this great study that Harvard did, is if you sort of take the names out of the equation and show the resumes, there's a bias, then we know that. And so we have to just be more conscious of plowing through that bias and working to maybe make sure that those funds are getting more amplified.
Yeah, and actually Harvard has a good resource that I recently heard about. It's an implicit bias test. And it's sort of a quick 10-minute screen. But one of the recommendations I heard was to take that test before you're about to do an interview of a candidate, for example. Perhaps for LPs, it's before you're about to meet a manager, because it helps create the consciousness in the moment of your own implicit bias. So you can look it up. It's a cool. I'm testing it out personally. Great. Well, I'm mindful of the time. I want to make sure we get to some of the questions. There's been some great ones in the chat. So Emily Green, why don't we start with you? Jenny can unmute you and you can ask your question. Hopefully.
Mute myself. Yes, sorry, I had to unmute myself. Hopefully you won't hear my dog whimpering in the background. This is a fabulous discussion. One of the things I was hoping you might touch on is whether or not the fund managers use or considered using brokers or some third parties or consultants to help them either find the right people or navigate those conversations. I'd love to hear a little bit more about that.
I can chime in quickly. I think Rudina might have a longer answer. We did not, just because of our fund size. So I think if we were bigger, I would have considered it, but I definitely didn't explore it very far. So Rudina, you might have a more thorough answer than I did.
We did, but only for a piece of it. So for perspective, again, we were a spin-out team. So about 40% of the capital committed to Glasswing came from LPs that had backed us in our old firm. So we started with the basis of LPs, but we did use a placement agent of that capital for a portion of it. They're a mix in general. Placement agents are a mixed bag. It's, some will spam everyone. Some are better than others. Some have a very strong reputation, but you have to be like, I'm thinking of Monument, but you have to be of a certain size. In fact, I think Maureen, aren't the founders of Monument Cambridge Associates alumni? I think they came from Cambridge, right? Yeah, so, there are some really reputable groups. What we really liked about AVEC is all they do is venture and early stage venture. So getting a placement agent or consultant in the context that you're using the term consultant, Emily, that really knows the asset class, I think was important to us, because then they will represent it accurately. And then the relationships with the LPs that they have go very, very deep and are thoughtful. And so we found them to be A++. The other facet that is unique to this particular group that I don't think we have seen elsewhere is the principals in this group actually invest their own capital just as LPs. So they don't just sort of try to generate, profits by simply marketing the fund. They are voting with their dollars, and it's not insignificant. So there's a really nice alignment. I think that's probably true for first and second funds. By fund 3, drawing from my past experience of where I was, dynamics change. You've either put your proof points on fund 1 and the exits, or you haven't. So fund 1 and fund 2, fund 1, you're selling the dream and the track record if you have it. Fund 2, you're selling traction, largely unrealized, and the dream still, and how the team has developed and how the thesis and strategy, etc. By fund 3, it's show me the money. So you're either successful or not. And I'm sure the LPs can speak to that better than I. But I say that because by fund 3, you probably don't need a consultant, at least not, or a placement agent, at least not to the same degree that one might have needed them for fund 1 and fund 2. And that's my 2 cents.
That's a great answer, Rudina. And I see somebody else, it was Heather here, asked a similar question, and you've just given a great list of criteria for how to think about placement agents. Thank you.
Great. Another question from the group. Deepa, do you want to unmute yourself and ask your question?
Absolutely. Well, this has been a really good conversation. So thank you for hosting, Fundraise. My question was more regarding, I think managing LP relationship is such a critical piece. So how do you set those expectations, be it for return or ongoing management of that relationship?
Would you want to, maybe we start with the GP side in terms of how you've thought about managing the relationship and setting expectations and keeping folks updated, and then we can flip to the other side of how do you like to be informed. Suzanne, you want to take that one?
Sure. let's see, I would say, again, our LPs, we don't have institutions in there. And I know many institutions have a very set and structured way they want to interact with you. So if I take sort of our basket of LPs all together and look at the family offices, which are, you know, probably the most run like an institution, it's we update them after every investment we make. And it is not a 25-page memo. It's one page, kind of gives a thesis, why we had such conviction in the team, you know, the amount we put in, and that's it. Sort of, you know, that's about it. We rarely have ever had calls or questions or anybody wanting to talk about it further, which may or may not be typical. But anyway, so after every deal is made, they get a memo from us, and then we typically reach out quarterly with a short update and then an annual letter, and then there's the annual meeting that you have to have as a fund. And so those are the big touch points. And then certainly for our LPs, I'd say that, you know, the ones that make up the bulk of the fund, we just try to build those personal relationships sort of more organically. And that's actually the fun part. I love the LPs that we've brought together, and it's allowed us to build some great connections, not just for our fund, but just in our sort of larger network in general. And so I've enjoyed it. I think, you know, all the GPs like, oh, we got to do that memo. We got to do that update, because it's not what you want to be doing. But I think when you have the right mix of LPs, it actually can be enjoyable.
Great. Alison or Maureen, anything different in terms of how you like to engage or be informed?
I would just say, you know, we like a pretty high level communication, or not high level communication, in more communication, I guess is what I'm saying. It's good for us. You know, we want to balance it with letting managers obviously do their thing. We're not calling them every month asking for an update, but I think it's really important, especially, you know, look at what's happened this year. And I've had a really good experience. I think we're pretty lucky, even with some of our larger managers. They, you know, we knew what the portfolio looked like going into it, and then they ramped up their communication during this kind of madness. And I can't say that about everyone that I've heard about, you know, so I kind of feel lucky that on the VC side, we've had that experience, because, you know, we knew where the concerns were. We've had managers, you know, we asked, and every time they delivered, you know, where are the concerns? Where are people that are benefiting from COVID and doing well from this? And how should we be thinking about deal flow? Because like a lot of the GPs have said, sourcing and diligencing is hard during this. And so, you know, I think, so I would say every few months at a minimum, in good times, and much more so during times like what we're going through right now, which is also easier right now, right? Because we can do this, and I don't have to fly, or the manager doesn't have to fly to me. And I think this has really opened our eyes to that quick update call, and how it doesn't necessarily have to be an airline ticket.
Thank you. I'm taking notes. I'm just kidding. Alison is one of our LPs. There was a great question in the chat from Abby. Abby, do you want to unmute yourself and ask your question?
Hi there. Yeah, so we've gotten a lot of conflicting advice from different LPs as we go about talking to them about which numbers are the most important ones to showcase on our initial deck. And so, you know, we've changed it from net IRR to MOIC to all these different ones based on the advice. And so I was just wondering, from your perspective, what are the 3 most important ones that you want to see right up front and center? And which ones can, you know, come at a later date?
Maureen or Alison, you guys want to start?
Yeah, I'll offer a few thoughts, and Alison, I think, will probably have much better thoughts. So part of it depends on where your fund is in its cycle, right? Because look, most people fundamentally want to know, have you paid back capital and then some? And in the early stages, it's about IRR, but you know, you've heard the phrase, you can't eat IRR, and you know the games that can be played with IRR. And then so money on invested capital, right? And then, you know, distributions to paid in. So, you know, I think it's going to depend on where you are in the portfolio, and each investment is going to be slightly different. We as a firm, we do benchmark against IRR, TVPI, DPI. MOIC is one that is probably a little more relevant than IRR at times, because it's, again, you know, starting to really fundamentally get to the question, the answer of what's the cash on cash, right? And early in the stages, you're not getting the cash back. You're not getting any money back. So
Yeah.
I think if the numbers
I
are
guess
good,
kind
put
of
'em
like
all
sorry, the follow-up to that then is how, like for a fund that's been around 4 years since their last fundraise, what are the ones that you're looking for versus like if they've been around 8 years from now? I'm assuming you're looking for DPI as their number one indicator.
I mean, I can take, because I agree with Maureen. I mean, I think they all matter, right? But I get what you're saying. I have found, or I've been told that there's some groups of LPs that definitely favor IRR over multiple. I am more in Maureen's camp. We certainly like to see multiple because I like that saying, you can't need IRR. You know, but I think after 4 years, you know, while we wouldn't expect, you know, we understand that it takes time to build up these companies, we would certainly expect to start to see something, right? Whether, and, you know, I think we've all done this long enough, we can kind of see why DPVI wouldn't be that great, but total value would, and it would sort of start the conversation of where is the value in your portfolio? Because total value can be misleading, but it can also help you tell us your story too, if things haven't actually been exited, but are certainly showing meaningful traction in the market.
Thank you. We are almost out of time. A thing I like to do at the end of panels is what I call a lightning round. So I have questions that I will ask, and it's a one-word answer. This first one's a yes, no, one-word answer. And I will pose the questions and then call on each of you to give your one-word answer. And I have 3 questions. Okay, so my first question is raising a venture fund harder than it was a year ago? Yes or no? Suzanne?
No.
Rudina?
No.
Alison?
No.
Maureen?
No.
All right. Does being a female GP raising a fund help you, hurt you, or doesn't matter? You can say 2 words in this one. Let's go opposite order. How about Maureen?
To me, it doesn't matter.
Alison?
I agree. To me, it doesn't matter.
Rudina?
It depends.
Okay. Option D. Okay. Suzanne?
I'm going to say it helped us.
Okay. This you can say a couple words. My final question. What is one change caused by the pandemic that you hope is here to stay? I'll go, how about Rudina?
Flexibility.
Suzanne?
Yeah, I love that one. Can I say it too? Flexibility.
Good one. Alison?
I agree, because it kind of wraps in that ease of communication, the working from home, less, travel. So I think flexibility is a great way to put it.
Great. And Maureen?
I'll make it a unanimous flexibility.
Great. Well, thank you all so much for joining us. We are very lucky to have you. This was a really thoughtful conversation. I personally found myself taking notes. And I appreciate you getting to the meat of stuff and being very real with this group. I'm excited by the size of this group. I think this was very valuable to a lot of people. So virtually everyone, applause for our wonderful panelists. Thank you all so much for joining, and stay tuned for future All Raise events, particularly from the Boston group. Tune into our Boston chapter of All Raise. Feel free to reach out to us or check out the website. But once again, thank you to my wonderful panelists, and I hope everyone has a safe evening and a wonderful holiday season. Thank you very much.
Thank you, Lily. You did a lot of background work and heavy lifting that probably the attendees didn't see, but we saw. So thank you for all that.
Thank you. It's a real pleasure. Thank you, everyone.
All right. Good night.
Good night.
Hi, Lily. You're on mute still.
Hi.
Hi. Thank you so much for running with this one. You did such a fabulous job leading the conversation. It was amazing.
Thank you. We're still waiting. Some people are still
Some
on
folks.
the line. But thank you. Thanks for all your background work and helping it.
Yeah, no, it was really super that you guys took this one over the finish line. I think it was our best attended, best registrations, best live attendance. I think we had a high point of 100 folks. It's amazing.
Too. And Jenny wasn't even sure if our Zoom could handle 100, so there might be more, but unclear if people could get in.
That was amazing.
Yeah, that was cool. I'm glad we opened it up. I think it's it's such an important topic, and it's not one that gets talked about that often. So I'm glad that we could open it up to more people.
Exactly. And I myself, for one, learned a lot. I think I'm going to go back to the recording and after I digested some more, and I downloaded a chat as well. Did you grab the chat?
Oh no, I would like to do that. I think.
Yeah, if you go to chat, you see those 3 dots at the bottom. And then if you hit that, you can save chat.
Oh, that's a great idea.
And then it drops it in your Finder and you can just grab it.
Thank you for that tip, because I couldn't read everything as quickly as I was facilitating.
But anyway, I just wanted to say you did a fabulous job. It was amazing.
Thank you.
And it'll be recorded, so maybe we can kind of promote the recording somewhere as well. And I also think we should think of, are there any topics that we can build on, like themes that came up today? I think we have our Boston chapter meeting on Friday, so we can circle back.
Good too. Yeah.
So maybe we can do a debrief there and just think if there's any themes that came up that we can build on for a next panel.
Yeah, that would be great. I think it's a good idea. I always am like, I'm going to write more content pieces. I wonder if there's a little piece of content that could come out of this, or we can make a little video. But yeah, why don't we debrief on Friday in terms of
that would be cool too, right? If you did a little, key takeaways type of thing, and LinkedIn posts do really well, and then we'll amplify that.
Yeah, that's a good idea.
That'd be awesome.
All right, maybe I'll take that on.
Or maybe on the All Raise blog, they might even get some good visibility there.
Yeah, that's a good thought.
Well, let's follow up on that. But anyway, thank you. It was awesome.
All right. Well, thank you for joining. I appreciate it. Thanks for all your help muscling it.
Okay, talk to you soon. Thanks. Bye.